Welcome to Chart of the Day. I'm Robert Folsom. What could follow the end of the 70-year rate cycle? Please don't be alarmed. This is not a geometry lesson. Nobody would hire me for that job anyway. Instead, what is on your screen is a chart you won't see elsewhere. Bob Prechter's analysis and observations depicting visually the 70-year interest rate cycle. This cycle includes two long-term trends in Treasury note yields, namely 35 years of rising rates in yields from this 1946 low up to this peak in 1981 when the 10-year Treasury note yield hit 15.84%. And then the trend reversed with rates falling for 35 years to this low in 2016. Obviously, the shape of the cycle is symmetrical, but if we zoom in on the broader conditions and events on the way up versus on the way down, what you see is asymmetrical. Here's what I mean. These 19 benign or comparatively problem-free years, 1946 through 1965, were stable in the U.S. economy, politics, and markets. After 1965 came 16 problem years, from a failed presidency to stagflation to oil shocks to the 1970s bear market in stocks. Conversely, after 1981 came these 19 benign years, the bull market time of Reagan and Bill Clinton and economic growth in the 1980s and 1990s. Then the year 2000 began 16 problem years, including two large bear markets and recessions, years of U.S. military engagements, and the deepest political polarization in more than a century. Now, this chart is from the Elliott Wave Theorist that Bob Prechter just published, February 17, 2017. Yet, he had published an earlier version of this chart 2 years ago in March 2014. So what's different? Well, rates did fall a bit further into mid-2016, which at the time led a national newspaper to declare, quote, ultra-low interest rates are here to stay, end quote. But also at that time, on July 1st, 2016, within a week of the low, Bob Prechter published a bond chart with Elliott Wave labels indicating a turn was at hand. That is what this arrow points to. You can see what yields have done since then. So back to the question we began with. What could follow the end of the 70-year rate cycle? Well, the answer may come by looking at the years before this long cycle began. From 1929, that meant 17 years of crisis, with deflation, the Great Depression, and World War II. Obviously, these are early days, yet if the symmetry holds, it suggests that the time to come could include years of crisis, deflation, depression, and possible World War.